Hurricane season officially started June 1st, and the headline this year sounds like good news. NOAA is forecasting a below normal season. The market here in Florida is calmer than it's been in years, and if you own a business in this state, that combination is exactly when you're most likely to get burned. Because a quiet forecast is when people relax. It's when you skip the coverage review, assume last year's policy is fine, and move on. I've watched it happen. So today I want to walk you through what this forecast actually means for your business and the 3 coverage gaps that turn one storm into a closed sign. Stay with me. This one is money in your pocket. Let's start with the actual numbers, because below normal gets misread. NOAA is calling for 8 to 14 named storms this season. Of those, 3 to 6 could become hurricanes, and 1 to 3 could be major hurricanes. That's category 3 or higher. They put a 55% chance on the season coming in below normal, mostly because El Niño is expected to develop and calm things down. So yes, quieter than the last few brutal years, but read that again. Below normal still means up to 14 named storms and up to 3 majors. Below normal is not no storms. It only describes how many show up. It says nothing about where they go. And here's the trap buried in that forecast. It counts storms. It does not count what happens to your street. A season can be perfectly quiet statewide and still wipe out your specific town, because all it takes is one storm finding your coast. Folks here on the Gulf side know this better than anyone. The years that flooded Main Street weren't always the years the experts called busy. So when you hear below normal and feel relieved, understand what you're actually relieved about. You're relieved there will be fewer storms total. That number does nothing for you if one of them parks over your county. The forecast is a statewide average. Your business is one address. Now there's real good news on the market side, and I want to give it to you straight. Florida's insurance market is the healthiest it's been in years. Around 20 new property and casualty insurers have come into the state. Citizens, that's the state-backed insurer of last resort, the one everybody got dumped onto when private carriers fled, has dropped from over 1.4 million policies at its peak in late 2023 to under 300,000 this spring. Private companies are taking those policies back. That's a genuinely good sign. But here's the flip side nobody mentions. A calmer market plus a calmer forecast is a recipe for complacency. When the panic fades, people stop checking their coverage, and that's the mistake. And let's be honest about price, because calmer does not mean cheap. The improvement in the market won't undo the last several years of premiums climbing. Owners in disaster-prone areas, which is a lot of the Florida coast, can still see increases over 20% on certain carriers and rating plans. And every expert covering this adds the same warning. One bad storm season could topple the progress we've made. So the picture is, rates are a little more stable, more companies are competing for your business, but you're still paying real money, and it's fragile. That actually argues for shopping your coverage harder this year, not coasting on it. More carriers competing works in your favor if you use it. So why am I, an insurance guy, telling you about a weather forecast? Because for a business owner, a hurricane isn't one problem, it's 3 at the same time. 1, the physical building and what's inside it. 2, your ability to actually operate, your power, your access, your equipment. And 3, your income while you're shut down. Most owners insure the first one, the building, and just assume the other 2 right along with it. They do not. Those are 3 separate questions, and often 3 separate policies. The owners who survive a storm financially are the ones who covered all 3 before the wind showed up. Let me take them one at a time, starting with the one that surprises people the most. Gap number 1, commercial property, and specifically the hurricane deductible. Here's what catches people. Your regular deductible, the one you think of, Might be $1,000 or $2,500, but almost every Florida commercial policy has a separate named storm or hurricane deductible, and that one is not a flat dollar amount. It's a percentage of your insured building value, so it might be 2%, 5%, sometimes more of what your building is insured for. On a building insured at $500,000, a 5% named storm deductible is $25,000 out of your pocket before the policy pays a dime. Most owners have never once looked up that number. After a storm is the worst possible time to learn it. So do this math today. It takes 2 minutes. Pull your policy, find your building's insured value, find your named storm deductible percentage, it's in the declarations, multiply them. That product is the money you personally cover on a hurricane claim before insurance kicks in. If your building's insured at $1 million and your named storm deductible is 5%, that's $50,000 on you. Knowing that number changes everything. It tells you how much cash you need on hand, whether your deductible's set too high, and whether you should be talking to your broker about options. The owners who get crushed aren't the ones with high deductibles. They're the ones who didn't know they had one. Gap number 2, and this is the big one in Florida, flooding. Here's what too many owners find out the hard way. Your standard commercial property policy does not cover flood. It never has. Wind damage and flood damage are two completely separate things in the insurance world, covered by two completely separate policies. Flood comes through the National Flood Insurance Program or a private flood carrier, and you have to buy it on purpose. And here's the kicker. A flood policy usually has a 30-day waiting period before it takes effect. So you cannot wait until a storm is in the Gulf and then go buy flood coverage. It won't be active in time. If you don't have it before the season, you're exposed. And let me connect that to how storms actually destroy a business, because it matters. In a coastal hurricane, the wind grabs the headlines, but the water does the worst of the damage. Storm surge, that wall of seawater a hurricane pushes inland, counts as flood, not wind. So if your only coverage is wind and standard property, and the surge comes through your front door, you can be sitting there with a denied claim while the building's gutted. That's the nightmare. It's not that you weren't insured, it's that you were insured for the wrong half of the storm. Here on the Gulf Coast, the water is the thing that closes businesses. You have to cover it on purpose, ahead of time, or it's on you. Gap number 3, and this is the one that quietly kills businesses even when the building survives. Business interruption. Think it through. A storm hits, you're closed for repairs, no customers, no revenue. But the rent's still due, payroll's still due, the loan payment's still due. Business interruption coverage is the policy that replaces your lost income during that downtime. It's the difference between riding out 3 closed months and never reopening. And here's the problem. A lot of small business policies are thin on it, or owners never added enough. They insured the walls and forgot the thing the walls were there to protect, the income. Property coverage rebuilds your building. Business interruption keeps you alive while it's being rebuilt. And business interruption hides in the fine print, so look at 3 things. 1. The time limit. How many months will it actually pay? A storm recovery can run longer than people expect, and if your coverage stops at 1 month, you're on your own after that. 2. The dollar limit. Is it enough to actually replace your real income? 3. The triggers. Does it pay if the authorities close your area even though your building's fine? Does it pay if you lose power for a week with no physical damage? Those situations are common after a storm, and whether you're covered depends entirely on how the policy's written. Coverage that looks fine on paper but doesn't trigger in a real storm is not coverage. It's a surprise. I want to be straight with you about the stakes, without being dramatic about it. A large share of small businesses that take a direct hit from a major disaster never reopen. Not because the owners weren't tough, but because the money ran out during the closure. The ones who make it through tend to have the same things in common. They had the flood covered, not just the wind. They had enough business interruption to carry the closed months, and they had the cash set aside to handle that percentage deductible. None of that is luck. Every bit of it is a decision you make before the storm, while it's calm, while you have time, which is right now. After the storm, your options are gone. And here's the deadline almost nobody outside the industry knows about. When a storm gets named and enters a certain distance from Florida, insurance carriers stop writing new coverage and stop letting you change existing coverage. It's called a binding moratorium. The window slams shut. So the idea of watching the forecast, seeing something headed your way, and then calling to bump up your coverage, that doesn't work. By the time the storm's a threat, the door is already locked. This is the single biggest reason to handle your coverage now, in early June, while everything's calm and every option is still open. The time to fix your policy is before there's anything to fix it for. One more gap, and it's a sneaky one: being underinsured on value. A lot of commercial property policies have something called a co-insurance clause. In plain English, it says you have to insure your building to at least a set percentage of what it would actually cost to rebuild. If you don't, the company can cut your payout. And not just on a total loss, on a partial one too. Here's why this bites right now. Building costs, labor and materials, have jumped over the last few years. A lot of owners are still insured at a number from before all that. So on paper you're covered, but you're covered to an old low value, and that co-insurance penalty quietly shrinks your check. Make sure your insured value matches today's rebuild cost, not 2020's. So here's the truth that ties all of this together. A calm forecast and a calm market are not the same thing as being covered. You can have a below normal season, a friendlier insurance market, lower stress all around, and still have a hole in your policy big enough to end your business. The forecast doesn't fill the gaps. The market doesn't fill the gaps. Only you and a careful look at your coverage do that. And the gap is always the part you didn't check. The deductible you never calculated, the flood policy you never bought, the income you never insured. Storms are very good at finding exactly that spot. The fix is to find it first, while it's calm. So here's what to do this week, while the forecast's quiet and every option's still open. Ask 3 questions. 1. What is my named storm deductible in actual dollars? My insured value times that percentage. And do I have the cash to cover it? 2. Do I have a separate flood policy that's already active, not something I plan to buy when a storm shows up? 3. If I'm closed for 2 or 3 months, does my business interruption coverage actually replace enough income for long enough to keep me alive? 3 short answers, 1 conversation. And in calm early June, every one of those is still fixable. Wait until a storm's named and the binding window's already shut and the answers are locked in. My name is Dennis Hendrickson. I'm a licensed insurance broker right here in Sarasota, Florida. And this is the exact work I do with business owners. Getting commercial coverage right before hurricane season. The property, the flood, the business interruption, all of it. With the market calmer and more carriers competing this year, it's a good time to review your coverage and push for better terms. And it costs you nothing to start. My contact info is in the description. The first conversation's free. And if this was useful, subscribe. Every day we break down a real business and risk story and what it actually means for your bottom line. The practical version, not the hype. Get this handled while it's calm. I'll see you tomorrow.